Hey everyone, happy Thursday, December 5th. It's a little bit before 10 a.m. on the West Coast, and it's time for another market update. Busy week this week. It's jobs week. That's very important. The Fed's paying really close attention to all the jobs data to make their decisions on rate cuts. We also heard from Fed Chair Powell yesterday, and then also it's the time of year where end of the year, a lot of these different outfits are coming out with their predictions for the housing market and rates and stuff in 2025. So I want to take a closer look at that. So first things first, like I said, it's jobs week. The first point of data we got this week was the October JOLTS report. It was estimated to come in about 7.5 million job openings, came in at 7.74. And like I said here, hires down, quits up. Meaning, so hires are down. Companies are, these corporates are hiring less people, but quits are up. And quits, the reason why we look at that is quits is oftentimes people quitting to get another job. The stronger, if the job market's really good for employees, then they're jumping job, from job to job, they're getting, more money, things like that. So quits are higher, but hires are lower, as you can see here. And then job openings is a little bit higher than it has, but nowhere near where it was back a couple years ago. So, and again, these job openings, it's the first thing you would think you would see weakness in, less job openings, but also, the way they count these is a little suspect with online job postings, jobs posted to multiple states if they're remote, things like that. So the numbers are a little iffy sometimes, but over the last couple of years, the Fed and everybody started paying closer attention to this report. Next thing we got yesterday was the November ADP. So this is private payroll. This came in, the estimate was supposed to be about 163,000 jobs created, came in at 146,000, but on the downside, wages increased. So taking a closer look, like I said, 146,000. The NSA, so non-seasonally adjusted number is 63,000. It's a little unusual that they would adjust up this time of year for seasonal adjustments. October actually was revised way lower. It came out 233 down to 184. So that's, again, just like the BLS jobs report, we don't get much positive out of that, but we definitely got a negative out of this 233 number when it came in really high. And then as you can see, business size, all these job creations, seasonally adjusted, are coming from large and medium-sized businesses, mainly large, smaller down. Looks like education and health services and trade and transportation led this. Construction was up 30,000, manufacturing down, which has continued to show weakness. And like I said, this is all mainly positive things for us. Revised down, lower than expected. Things like that. This part is what the markets didn't like. For the first time in 25 months, job stayers, their wages went up slightly from 4.7 to 4.8, and job switchers, people jump and ship to another company, went up from 6.7 to 7.2 wage increases. So the reason, we don't like that, the Fed doesn't like that, wage inflation, the more people are making, tend to be the more they spend, that could lead to inflation. So overall, kind of a mixed report. Next thing, so initial jobless claims came out today. It's been really low. It jumped a little bit to 224K, but this is a wonky week with Thanksgiving and all these adjustments. So, not much really to pay attention there, but I guess nice to see it jumped a little bit, even though we don't want to see people lose their jobs around the holidays. Next thing, so miscellaneous. We had, some Fed speakers, throughout the week, including Fed Chair Powell yesterday. So taking a look at his comments. So basically, he's saying the economy is in very good shape. There's no reason for that not to continue. Downside risk in the labor market appear less than they thought originally. Growth is stronger than they thought. Inflation has come a little bit higher. So those are all not necessarily the positive things. It's good for the economy, not necessarily good what we want rates. We want inflation down. We want them to be worried about the job market, so that way they cut rates to stimulate growth. But as you can see here, these are in different inflation reports, CPI and PCE. The 6 month, average 2.5 for CPI, 2.3 for PCE. But as you can see over the last few months, that 3 month, it's been jumping. It went from 3 to 3.5% in CPI and 2.3 to 2.8% in PCE. So over the last few months, inflation's got a little bit higher, and that's what the Fed is looking at, thinking, hey, we don't want that to happen again. We don't want inflation to get out of control. And as you can see his comment right here, we can afford to be a little more cautious as we try to find, the neutral rate. So basically what they're saying here is they can be a little bit more cautious in cutting rates. They don't have to cut rates as fast, which is not what we wanted to hear from Fed Chair Powell. So, obviously they're going to be paying really close attention to the rest of the data as we go forward, but that was not necessarily the best speech he gave yesterday. And then rent prices, this one goes into inflation. We know rent has been really, inflated over the last few years. Rent prices keep dropping year over year, according to Apartment List. New rents are, negative year over year. So we're just waiting for that to show up in those inflation reports. So that's at least a positive on the horizon. Where does that leave us? Average 30-year down from 6.95 last week to 6.84. Moved in the right direction, but depending on how the rest of the week goes, that could jump over 7 the next day. So still in the high sixes, not what we'd like to see. And then, like I said, I want to take a quick look ahead to 2025 rate and housing predictions from different outfits. First, starting with Realtor.com. Realtor.com is showing they think the average conventional mortgage rate will be about 6.2 in 2025. So that's, three-quarters of a point lower than it is now, but obviously not as low as we'd all like. Existing home sales, they expect to jump 1.5% to 4.1 million, and home prices appreciation year over year, they expect to go up 3.7. National Association of Realtors has that rate near 6%. Existing home sales going up 4.4 and home prices appreciating 2%. Zillow, maybe smartly, is not making a prediction on mortgage rates right now. They have existing home sales going up to 4.3 as well, and home prices going up 2.6%. And then MBS Highway, this industry, aggregate that looks at rates and things like that, which I look at quite a bit. They have rates coming down to 5.75, so a little bit better than everybody else by a quarter of a point. Still not as low as we'd all like. Existing home sales at 4.5 million and home prices going up 4%. So they're the most positive, optimistic over the next year. But everybody's pretty close as far, especially this existing home sales, home price appreciation. Everybody's saying somewhere between 5.75 and low sixes for rates. Your crystal ball is as good as mine. It'll be interesting to see what happens. Obviously, the new administration, how inflation goes, how the job market goes, that's all going to play into things, and just how strong our economy is here in 2025. So ideally, we go lower here, but I like the appreciation. I like existing home sales going up, and I like at least rates coming down a little bit. Next thing, so important dates. So tomorrow is the big one. We get the BLS jobs report. This one's been a killer for a couple years now. It just tends to come in overinflated than it has been, and then they make adjustments later. But remember, last report, there was only 12,000 jobs showing created that had a lot to do with strikes going on the East Coast or across the country, had to go a lot with hurricanes on the East Coast. So we're expecting a little bit of bounce back from that. So, it'll be interesting. There's a lot of different factors that go into it, seasonal adjustments. It should be coming down so they can seasonally adjust, but it's just one we can't trust over the last couple of years. It's definitely been a killer for rates. So fingers crossed that doesn't blow things away. They're expecting jobs to be about 210,000 jobs created, and they're expecting unemployment to rise to 4.2% from 4.1. If we see unemployment drop, if we see more jobs created, that'll be bad. If we see unemployment go up more than expected and less jobs created, that will be good for mortgage rates. And then we get CPI inflation next week on the 11th, and then 2 weeks from yesterday, we get the Fed's next meeting where they're going to make that announcement. Right now, the markets have a 70% chance they'll cut by a quarter of a point, 30% chance they will do nothing. But after Fed Chair Powell's speech yesterday, next year we had it about 25 basis point, quarter point cuts. So full point cuts next year. Right now, the market's having only about 3/4 of a point cut. So, him talking so positively about the economy dropped that by a quarter point yesterday. So, fingers crossed about that BLS jobs report. Let's hope inflation comes in good next week before I talk to you guys. And I hope you guys have a great week, and we'll talk soon. Thanks a lot.